Okay, so number one reads, what is the value of the preferred stock when the dividend rate is 16% on a $100 par value? The appropriate discount rate for the stock is 12%. So here, this is a case where, as I said earlier, the dividend rate is given as a percentage of par value. The par value is not what it trades for. It's just something that's just written into the issue. Par value is $100. The dividend rate is 16%. So the actual dividend is 16% times 100, which is $16. And then that's for the value of the preferred stock. That's just the perpetual dividend divided by our required rate of return, which is given as 12%. 16 or 0.12. So $133 will be the value of that thing, that stock. And number 2 and number 3 are pretty similar. Let's go down to number 4, still with the preferred stock valuation, but slightly different. Number 4. Pioneer preferred stock is selling for $33 per share in the market and pays a $3.60 annual dividend. What's the expected rate of return on the stock? Well, again, that's just rearranging the equation. Is the price of the stock, is the dividend divided by the price, which in this case is going to be 360 divided by the price is $33. 360 over 33, 10.9%. That's the expected rate of return on the stock. That's 8. And B, if an investor's required rate is 10%, what's the value of the stock for that investor? Well, here the value is the perpetual dividend, 360 over the required rate of return. 360 over 10 would be, what, $36? And then C, the required return, the value of the investor is 36, and that's greater than the actual price of the stock, which is 33. So that investor would say that that stock is undervalued and it will be a good buy. We're going to buy that stock. That investor would be willing to buy that stock at any price below $36, since they think it's worth $36 in present value. 33 is the price. It's given in the narrative. So the stock is right now selling for $33. Our hypothetical investor believes that the present value of the dividends the stock is paying is $36. So he would be willing to pay up to $36 for that preferred stock. Yeah. Okay. So straightforward. First, I like the first stock questions. They're relatively easy. Skip down, let's go to the next page, actually. Let's go to number 8, which is Crosby Corporation common stock paid $1.32 in dividends last year. This is common stock, not preferred, so it's going to be different. It's expected to grow indefinitely at an annual rate of 7%. We want to know what the value, if the required return is 11%, then what is the stock worth to you? Here we're going to use the value of common stock as D1 over R, common stock required rate, minus G, the growth rate in dividends. So in this case, that is, well, we don't have D1, we have a recently paid dividend. It just paid $1.32. That's all. So $1.32, we have to increase that by the growth rate. given, it said the stock's growing at 7%, so 1.07. Divided by the required rate, which is given as 11%. That's 0.07. Before it came from 11 minus 7 is 4, so start. So whatever that turns out to be, $35.31. And actually, the next one is really short one, number 9. Number 9, they're asking, well, let's read it. To say a corporation wants to achieve a steady 7% growth rate, if it can achieve a 12% return on equity, then what percentage of earnings must they retain for investment purposes? And the equation, remember from the slides, the growth rate is the return on equity times the profit retention rate, PR, we call it PR. Profit retention rate is times return on equity tells us the growth rate in the firm, the value of the firm. Well, the growth rate in earnings is what that would be. Rearranging this, we want the growth rate to be 7% instead. So that's going to be 0.07. And we know what retained earnings is. We're solving for the profit retention rate. How much needs to be retained to allow the company to grow? So rearranging this, we have profit retention rate is equal to the growth rate that we want divided by the return on equity. So that's 0.07 divided by, what is it, 12%. That's 0.58 or 58%. So, yeah, 58% of earnings will be plowed back into the firm for investment in assets. And let's do one more and then I'll. May as well do 10. Number 10, Dalton has a 11.5% return on equity, retains 55% of earnings for reinvestment. They recently paid a dividend of $3.25. The stock is currently selling for a price of $40. In part A, they ask, what is the growth rate? What is the growth rate? Well, the growth rate, we just had the equation, the growth rate is return on equity times the profit retention rate. In this case, that is return on equity is 11.5%, so 0.115, and the retention rate is 55%, so 0.55. Gives a growth rate of 6.335, 0.06335. Okay. And part B was the expected return on the stock. Well, the equation for that is the same equation as we used earlier, where B is T, the price, is D1 over R minus G, but we're going to rearrange it to put R on the left-hand side. We get R, return on the common stock, is equal to D1 over the price plus G. D1 is the recently paid dividend, $3.25, times 1 plus G, so 1 plus the growth rate, 106,335. Divided by the price, T is given as 40, plus the growth rate again, 6.335%. So, 14.96%, checking on that. And then in C, I believe it's 14.9, about 15%. And then part C, if you require a 13% return, should you invest in the firm? You're requiring 13%. This thing is expected to return 15%. So should you invest? Yes. 14, expected rate, return is 14.96, which is greater than your required rate of 13.0. As we talked about before, if the expected rate is higher than the required rate, then you would buy it. If it's less, then you would sell.